SMEs don't like banks. Or is it the other way around? Banks don't like SMEs? Or maybe it's just a mutual thing. They both do not like each other. SME refers to small to medium enterprises. They are typically classified as such based on how much revenue or turnover they generate in a financial year. And studies have shown that SMEs tend to have many other similar characteristics which go beyond turnover. And fortunately, one of these characteristics is high credit risk. The default rate among SMEs or small businesses is rather high. Then, researchers say that less than 30% of all these new businesses will make it beyond year number 3. And then among those that do, very few ever have consistent or recurring business. Now, a bank's job is to be a financial intermediary, a middleman that takes deposits from savers, which includes individuals like you and me, with book balance or a few thousands on their account, to large corporates that keep millions and millions. Then it extends this in form of loans to borrowers. These can either be individuals, companies, large or indeed SMEs. Therefore, a bank does not lend its own money. It simply pools yours and my deposits, then gives them in form of loans to borrowers in a more efficient manner. At the same time, the bank is expected to ensure that whenever you or I walk into the bank and ask to withdraw money from our account, that they are going to have enough money to give us. Meaning that a bank must always walk that delicate line, making sure there's enough liquidity to satisfy demand for withdrawals, but also at the same time, make sure there's not too much so that they're optimizing their earnings through extending loans or investing in bonds or other such securities. On top of that, the Bank of Zambia provides oversight to make sure that the bank's liquidity and capital adequacy ratios and other such complex things stay within a specified range. That is done to safeguard our deposits as well. Which means that before lending out any money, the bank is expected to conduct credit assessment to determine the probability of that money being paid back. So for a bank, taken on a case-by-case basis, the manpower it would take to process a 100,000 kwacha loan for an SME could be the same as required to process a 100 million kwacha loan for a large corporate. And obviously, the bank is going to make more money from the large corporate. So why do the SME, right? So, as a way to make it more economically viable to extend credit to smaller businesses and individuals, many banks have designed one-size-fits-all credit products which can accommodate small borrowers. That is why you have things like salary-backed loans for employees of pre-approved companies, so they don't have to do it one by one. Or trade-related products such as order financing and invoice discounting for SMEs. The banks prefer such type of products because the source of repayment is fairly predictable and the process as well is manageable. For employee loans, for example, they can deduct their repayment from your salary. For order financing or invoice discounting, the bank will get paid when the invoice is settled. There is not too much speculation involved. Now, since the credit assessment for these smaller borrowers has been standardized and is predefined, in order to qualify, a borrower is expected to tick certain predefined boxes as well. So you can say that SMEs sometimes make their own lives difficult when they do not pay attention to the main things that the banks really care about. For example, back in the day, we used to say that a man needed 3 C's in order to get a wife: a crib, cash, car, or house money car, as Nalo put it. Similarly, the bank looks for 5 C's and they haven't changed. The most important for them is character. They want to lend money to companies whose owners are known to have integrity, who follow best business practices, and who have a good credit history. So one of the simplest ways, actually two, for you to show good character is 1, have a board in place, and that shouldn't just be you and your spouse. And number 2, keep your books in order. If you have audited accounts, that's a very good sign. It tells the bank that you are serious about your business. Also important, those accounts will show the bank 2 other C's, which are capacity and capital. The bank wants to see just how much you believe in your business based on how much of your own money you risk. So how much capital have you invested? That will be seen in your accounts. Capacity is basically looking through those books to determine whether you'll be able to implement the plan that you are pitching to them based on your track record. You see, when you can show where you're coming from, the story of where you are going becomes more believable. Otherwise, you'll be taken to be just another dreamer who's building castles in the sky. And no bank will want to take a gamble on such a dreamer. The other C is the most commonly talked about, collateral. While important, the bank will often make its decision based on your character, capacity, and capital before they even look at your collateral. In fact, in most cases, they will even look at the final C, which is conditions. That refers to the interest rate and duration of your loan, even before they consider your collateral. Think about the 5 C's and see how best in which you can meet the expectations of the banks. Thank you for watching, and I'll see you next time.